So to answer this question, we can have a look at the publications of the European Systemic Risk Board. The European Systemic Risk Board was established after the financial crisis by the European Union to monitor the financial stability of the financial system in Europe. In its recent annual report, the European Systemic Risk Board finds that the European banking sector is shrinking. So since 2009, total assets of regular banks in Europe have fallen by 10%. At the same time, the IMF reports that shadow banking is increasing in Europe. Examples of shadow bank institutions are money market mutual funds, investment funds, or securitization vehicles. And over the last 10 years, shadow banking in Europe has been on a slow but steady upward trend, which has barely been affected by the financial crisis. And in principle, it need not be a bad thing that financial intermediation migrates from regular banking to more market-based systems, but it's important to keep into account that shadow banking means financial intermediation without a formal safety net, such as deposit insurance for the case of regular banks. But also regular banking can be a source of concern. The asset quality review carried out by the ECB in 2014 found that banks had overvalued the book value of their assets and undervalued the amount of non-performing assets on their books. The amount of non-performing assets had to be corrected upwards by 18%. The banks with the lowest equity ratios and the highest leverage ratios were the banks which had to correct the numbers the most. And these were also the banks which were hit most and had the highest losses in the hypothetical adverse stress test scenario. In the future, equity requirements under the new Basel III regime will be tighter. This will mean that many European banks will have to raise the equity ratios. And this may mean that the migration of lending from regular banking to shadow banking may continue.